In 2008, when the last housing market crash happened, it was terrible for many people all over the country. Many families couldn't pay their mortgages anymore, homes were going into foreclosure, and people were losing their jobs all over the place. Could something like this really happen again? Is now a good time to buy a house? Or should you wait until the market crashes? This might be your last chance to buy a house if prices keep going up. But if prices do go down quickly, it could be a great chance for you. What does a crash in the housing market look like? And how can you get ready for one? This video will not only talk about how often and how bad a housing crash could be, but it would also show you how to buy a house that is a great investment. In this video, I'll take you to how can a housing market crash affect you. This video will definitely be worth your time for a simple reason that if you make a smart decision about your largest purchase, it may affect your finances for the rest of your life. If you're new to the channel, hit the subscribe button and that little notification bell icon so that you don't miss out on any of our video updates. Plus, it helps us spread the Thrive Wise love to help more people thrive wisely. Now, let's begin. A housing market collapse occurs when there is a sudden and dramatic drop in real estate prices. A drop in property prices may have a devastating effect on a family's net worth, since it represents the single greatest asset for many households. It may lead to significant cuts in expenditure, which in turn can lead to price reductions throughout the economy. You see, there are many parallels between a drop in property values and the stock market. Since interest rates are a big part of monthly mortgage payments, they make homes less affordable to buy. Over the past couple of years, even a 1 or 2% increase in the monthly payment has made a big difference. We've had very low interest rates, which made more people want to buy homes, but now those rates have gone up, making it harder for some people to qualify for and even pay for a mortgage. Higher unemployment, bad lending practices that give loans to people who aren't qualified, skyrocketing inflation that makes everyday costs almost impossible to pay for, and a drop in consumer confidence could also hurt the housing market. Many people worry that there will be another big housing crash like the one that happened during the Great Recession. It's easy to see why, since prices have been going up since then. It seemed like everyone owed more on their homes than what they were worth. Because of this negative equity, job losses, and other problems, there were a lot of short sales and foreclosures. The sudden influx of these properties on the market contributed to the steep drop in prices, which could happen again. But if you look in the past, steep drops like the ones we're seeing now are very rare. In fact, this is the only time they've dropped a lot in recent history, with the crash showing historic drops of about 20%. The Great Recession was different because the housing market caused it, not the other way around. If you look at this graph of the average home price, you can see that even though prices change from year to year, they usually don't go down by a lot. When home prices reached their all-time high in 2007, it took over 6 years or until late 2013 for them to reach that level again. That means that if you bought at the top of the market, you would have lost money for more than 6 years. Aside from this unusual time, you can see that prices of homes rise steadily from year to year. When prices do go down, they do so by only a few percentages here and there, and the drops don't last for long. First-time purchasers would rejoice at the thought of a decrease in housing prices. It would be great to be able to buy a house at the same price as it was a few years ago, or even better, a decade ago. It seems to reason that as rates go up, property values would fall because more people will find it unaffordable to purchase a house. Are we likely to see any tangible benefits from these price cuts though? Take a look at this example. Putting a 5% down on a $500,000 house with an interest rate of 3% would mean a monthly payment of $2,825 for principal, interest, average taxes, and insurance. Now let's say you get lucky and home prices fall by 20%, which would be the same as the biggest drop in history. In other words, to get a 20% discount, you'd have to compare the very top to the very bottom, which means you'd have to be there at the exact right time. Now that prices are lower, you can buy the same house that used to cost $500,000 for only $400,000. Your interest rate might be 8%. Your monthly mortgage payment is now $3,467. This is a great chance for someone with cash. But is it really a great chance for someone buying their first house? The short answer is that it depends on how long you want to keep that loan with a high interest rate. Peter Lynch, a well-known manager of hedge funds, has said that investors have lost a lot more money getting ready for or expecting corrections than they have lost during the corrections themselves. Even if home prices go down, that doesn't mean you're better off than someone who bought a home a year or two ago. Even if prices drop by 20% or more, people who bought their homes a few years ago will still be ahead. At the bottom in 2020, the average price of a home was 31% less than it is now. If you look at a graph of home prices, you can see that they almost always go up. So was it reasonable to expect a drop like never before? While you wait for a possible 20% drop in home prices, prices could go up again. Buying a home is a long-term investment, so you should think about how much it will cost in the future. Here's a question: if you buy a house now, would it be worth it? Alright, before answering that, I would like you to do something for me. Pause this video right now and do me a huge favor by hitting the like button and click subscribe if you are new. If you did, you're awesome, and thank you so much for your support. And going back, if you buy a house now, you should think about how happy you'll be with it in 2, 5, or 10 years, not just 6 months. Prices for homes could definitely go down, and anyone who wants to buy a home should know this. Recent events such as big drops in the stock market, increasing interest rates, and skyrocketing inflation makes home prices go down. No one knows for sure where things are going, so it doesn't make sense to worry about it too much. Just be ready for anything. This strategy rarely works, just like trying to time the stock market, unless you're a professional investor. Instead, you should focus on things that you can control that will make it much more likely that your home will be a great investment. Stick to areas where people are moving into, not out of, when you're looking for a home. Think about how close you want to be to stores, schools, highways, airports, attractions, and areas that are being improved and growing. Purchase the worst house in the best area. Not literally, but the point is that homes in nice areas that are less expensive tend to go up in value more quickly because they have more room to go up. Let's put it this way: even if I can afford the biggest house on the block, I would definitely want to live in a nice neighborhood. With that being said, don't buy a house just because it has new features. You should buy a house based on its location, yard, design, quality of construction, and other things. Unlike trendy flooring and light fixtures that will look old in a few years. These are things that will always be there, so stick to the lower end of your budget and make sure you have enough money left over for maintenance, repairs, and upkeep. It won't end well if you max out your monthly budget only to find out that the cost of owning are much higher than you thought. Buy a house with an opportunity to earn money, like a mother-in-law suite or a separate apartment. If you ever want to rent out the whole house when you move to a new one, this is something to think about. If you rent out part of your home, the money you get from that can be used to pay off your mortgage if you want or need to. Choose a home that you like and that other people will like too, in case you ever want to sell it. Most first-time buyers only stay in their homes for 2 to 5 years, so it's not reasonable to try to spend more than you can afford in order to find your forever home. Look at the purchase from a value perspective and try not to let your feelings get in the way. Many buyers choose a home based on how they feel about it, which is natural. Buying a home is an exciting process, but you shouldn't make a long-term choice based on how you feel right now. There will always be something that makes it hard to buy a home, whether it's rising prices or interest rates or something else. Just like buying stocks, starting a business, changing jobs, or doing anything else, no time is better than the present to start learning about home market cycles and forming reasonable projections for the future. If you have all the finances in order and approach a purchase from an investing perspective, you'll increase your odds of making a wise decision. Well, that's basically a quick talk on how can a housing market crash affect you. And thank you guys so much for watching today's video. And hey, it seems that YouTube thinks that the next video can completely transform your financial situation. Watch it to find out whether they're correct. And please don't forget to click the subscribe button to see more videos on how to thrive wisely. Till next time.